The index fund bubble. Hidden danger or safe bet? In 2019, John Miller, a well-known investor who made his mark during the 2008 financial crisis, raised a warning that index funds could become the next bubble, much like the complex financial products that triggered the crash more than a decade ago. His point sparked a lot of debate in the investment community because index funds have long been seen as a safe and reliable choice for everyday investors. At their core, index funds are simple. Instead of trying to pick individual winners in the stock market, they buy all the companies in a major benchmark like the S&P 500, matching their proportions. This approach lowers costs, reduces the need for constant decision-making, and helps investors avoid some of the risks that come with actively managed funds. For many, it has been a straightforward way to grow wealth over time without needing to be a market expert. But Miller's caution adds an interesting twist. If too much money flows into these funds, prices may become distorted, and the stability people rely on could be challenged. It is a reminder that even with tools designed to be simple and safe, no strategy is completely free of risks in the financial world. Miller has argued that many people put their money into index funds not because they carefully analyze businesses, but simply because these funds carry a trusted name. That popularity, while understandable, may push prices far above the actual value of the companies inside the index. When too much money flows into an investment for reasons of reputation alone, it can create distortions that later prove risky. To highlight his concern, Miller compared index funds to collateralized debt obligations, or CDOs, that played a central role in the 2008 financial crisis. At first glance, the comparison sounds alarming, but there is also an important distinction that investors should not overlook. Unlike CDOs, which bundled risky subprime loans into complicated financial packages, index funds are far more straightforward. They simply hold shares of existing companies that are already listed in major indexes. In other words, they do not invent new financial products or create extra layers of hidden risk. This difference is critical. It means index funds remain a useful and relatively safe tool, but Miller's warning is a reminder to stay alert. Even a simple product can become problematic if investors stop asking questions and blindly follow the crowd. By 2024 to 2025, passive funds have grown dramatically, now making up nearly 60% of the market share among equity funds. At first glance, this number sounds enormous, and it is easy to assume that passive investing dominates the entire U.S. stock market. But the reality is a bit different. In fact, passive funds only account for about 13% of the total U.S. equity market, which puts things into perspective. When you look more closely at trading activity, the picture becomes even clearer. For every $23 exchanged in the market, $22 come from active investors making deliberate buy and sell decisions. That means stock prices are still shaped mostly by the actions and judgments of active traders, not by the steady flows of index funds. This distinction matters because it challenges the fear that passive investing might completely control or distort prices. While passive funds have become a powerful force in terms of long-term ownership, they remain relatively small players in the daily ebb and flow of stock movements. In short, the market's heartbeat is still set by active investors, and passive funds continue to play a quieter, more background role. Even if index funds continue to take a larger share of the market, economic theory suggests that balance will naturally return. According to Grossman-Stiglitz's framework, if prices drift too far from their true value, active investors will re-enter the market to capture those opportunities. Their actions help correct mispricing and prevent the market from becoming paralyzed. In other words, the system has built-in checks and balances that keep it functioning. This perspective weakens the argument that index funds could create a massive bubble on their own. Unlike the complex and opaque financial products of past crises, index funds are transparent and straightforward. They simply follow the composition of existing indexes without introducing new layers of hidden risk. The takeaway is both practical and reassuring. For most everyday investors, low-cost index funds remain one of the smartest ways to build long-term wealth. They offer diversification, reduce the stress of trying to pick winners, and allow people to stay invested without needing to track every market swing. While no investment strategy is completely risk-free, the evidence suggests that index funds are not the ticking bomb some critics fear, but rather a steady and sensible choice. David Johnson, the founder of Vanguard, once shared a simple but powerful idea. Sometimes the best strategy is to do nothing at all. Just hold on patiently to an index fund. At first, this advice may sound too easy, even a little boring, but that's exactly the point. In a world where investors are constantly chasing the next big opportunity, endlessly checking prices and reacting to every piece of news, choosing patience can actually be a competitive advantage. Index funds are built on the belief that long-term growth of the market is more reliable than short-term predictions. By staying invested and resisting the urge to jump in and out, investors give compounding the time it needs to work its magic. Over years or decades, this quiet approach often outperforms the more stressful and costly path of active trading. Johnson's perspective is a reminder that investing doesn't always have to be exciting to be effective. Sometimes the smartest move is the one that feels the most ordinary. Buy a low-cost index fund, stay disciplined, and let time do the heavy lifting. In the end, patience often turns out to be the most profitable strategy of all. Honestly, I think this whole index fund bubble debate shows how easily fear can spread in the investing world. To me, index funds remain one of the most practical tools for long-term investors. They give everyday people a chance to grow wealth without trying to outsmart Wall Street. Of course, no strategy is perfect, and it's true that too much blind trust can create risks. But compared to the chaos of chasing hot stocks or timing the market, I'd still choose broad, low-cost index funds every single time. What do you think? Do you see index funds as a safe path to financial freedom, or do you believe we're ignoring hidden dangers? Share your take below.